Big round numbers and new records on Wall Street today. The Dow is near the 16,000 level for the first time ever. The S&P 500 index just points away from 1,800, a new milestone, and NASDAQ 4,000 just around the corner, a level not seen since 2000. Those are new records for the Dow and the S&P, and both averages have posted gains for 6 weeks in a row. Also closing at new highs, the Dow Transports and the S&P Mid-Cap 400 stock index. So here's a rundown of the closing numbers today. The Dow jumped 85 points. The NASDAQ added 13. That's a new, fresh 13-year high. And the S&P rose 7.5 points. Seema Modi has more on the recent bull run-up, which stock sectors are making the biggest gains, and why high dividends really matter to investors.
Stocks have been on fire this year. One of the big reasons, the Fed's monetary policy. And with Fed nominee Janet Yellen's dovish commentary yesterday,
we expect to maintain a highly accommodative monetary policy for some time to come.
Expectations are that rates will stay lower for longer, and experts say that's a boon for stocks.
The strength in equities owes much to very low interest rates. Fed funds may be close to 0% until the middle of 2015. Bond yields moving higher. I don't think that the equity market will come under much pressure from significantly higher interest rates anytime soon.
Historically speaking, in a low-rate environment, high dividend-yielding stocks do outperform as investors are on the hunt for yield. Healthcare and consumer staples, two sectors that offer the highest yield, are up over 80% since the Fed cut rates near zero in 2008. And while consumer staples and healthcare stocks are already up double digits this year, analysts say some of the stocks in these sectors are trading at an attractive valuation. Within pharma, Pfizer trading at a discount to its peers, and in the consumer staples sector, Altria and Walmart. But some say these defensive sectors are overvalued, and technology is the place to be. In fact, many of the large-cap tech giants offer an attractive dividend yield. Apple and Qualcomm both offer a dividend yield above 2%. Although Dan Greenhouse at BTIG says with the yield on the 10-year Treasury note rising, investors are becoming more selective and looking for names that offer a yield higher than the yield on the 10-year note. According to Wisdom Tree, fewer than a third of stocks on the S&P 500 have a dividend yield above 2.7%, which is the yield on the 10-year Treasury. Big names in that group, AT&T, Entergy, and PG&E. But whether it's defensive sectors like healthcare and consumer staples or high-growth sectors like tech, one theory experts agree on, dividend stocks will be high in demand as long as interest rates remain low. For Nightly Business Report, I'm Seema Modi.
And joining us now to talk more about the financial markets and what it means for your portfolio is Darrell Cronk. He's Regional Chief Investment Officer at Wells Fargo Private Bank. Darrell, thanks for joining us tonight.
Thank you, Bill. Great to be here.
Are there any headwinds that could stop this? I mean, we've had 6 straight up weeks now. We've been through the tough months of September and October with great gains. Where is the weakness in this market?
Yeah, I'm not sure you're going to see a lot of it. I mean, we only have 30 trading days left in calendar year 2013. So I think we'll start to look forward into 2014, Bill. And as we look into 2014, I think the environment sets up really nicely for overall economic growth and some decent earnings growth in 2014. So I'm not sure there are a lot of headwinds. Valuations are reasonable, both on an absolute basis and certainly on a relative basis to your earlier point and the earlier segment about where interest rates are. And also don't forget cheap inflation at today's, or low inflation at today's levels.
Darrell, I'd like to follow up on the report that we just had from Seema, where she is talking about, you know, the Fed-friendly market. But at some point, the Fed is going to cut back on the stimulus. What are the companies that you think will be the growth winners in that environment? And do you agree with some of the stocks that Seema was talking about?
Yeah, actually, I think as you turn the page into 2014, what we're really focused on is you've got to think in terms of what I'd call growth winners versus liquidity winners. And so what I mean by that is sectors of the economy that are going to stand on their own 2 feet on growth and not necessarily just be dependent on the excess liquidity in the market. So I would give you, Susie, a couple of sectors. We like the tech sector. Certainly valuations there. The tech sector is trading at a discount to the market multiple today, and it normally trades at about a 20% premium. So extremely cheap. And actually technology companies as a sector have more cash on their balance sheet today than they do debt. They have low payout ratios, so really favorable. We also like the industrial sector. That tends to be a sector that benefits mid-cycle to late cycle, and you're seeing the U.S. manufacturing renaissance really play through to that. So those are growth-winning sectors. You know, liquidity-winning sectors are going to be things like utilities and telecom, maybe to a lesser extent healthcare, that we think valuations are getting a little stretched there right now, to be honest.
What about those? Well, you mentioned utilities, but dividend players, I mean, those that have been helping people achieve a yield you can't get in the bond market, and they have been a darling of this market for a couple of years now. Is that too crowded a trade, or would you look to them as well right now?
No, we've actually got most of those, Bill, underweight right now. So if you look at utilities, telecom, probably the two, maybe staples to a lesser extent. We do think staples will still benefit simply from the wealth effect of the consumer and continuing spending, but those pure dividend plays look really expensive to us right now. So while you can't get away from them completely, and it's important to have a diversified dividend in your portfolio, we think they look expensive. The only other point I'd add to that, Bill, is we're looking globally and internationally to dividends right now. If you look at a lot of countries overseas, their actual dividend rates are considerably higher than the U.S., and you get better diversification benefit as well, and in some cases a much more reasonable valuation level. So I think investors have to look global as well as just domestic and staying with domestic S&P sectors.
Darrell Cronk of Wells Fargo Private Bank. Thanks for joining us tonight, Darrell.
Thanks, Bill. Appreciate it.